Welcome, Money Magnets, to the latest episode of our Money Magnet podcast. This month, we are celebrating Heritage Day in South Africa. So it's a perfect time to reflect on our diverse cultures and shared history. And what better time to discuss an essential topic that affects all of us. Who can we trust with our money here in South Africa? Joining me today is my co-host Alex.
Hi everyone. Heritage Day is the perfect backdrop for this discussion. Just as we cherish our cultural heritage, we need to be diligent about safeguarding our financial heritage. Trusting the right people with our money is essential for building a secure financial future.
I could not agree more. Trust in finance is as fundamental as trust in our personal relationships. Without it, our financial plans can crumble. So let's deep dive into who we can trust with our money and how to make informed decisions.
Well, why is trust so important in financial matters? Picking the right advisor or bank for you is crucial, as it is all about ensuring your hard-earned money is in safe hands, usually for a long time, so it is worth it to spend some time selecting the right person.
Trust is a cornerstone of any relationship, and that is particularly true for a financial relationship. When you trust someone with your money, you're essentially giving them a role in shaping your future. You need someone who understands your goals, has your best interest at heart, and can guide you through financial complexities.
Exactly. So who are the key players you can trust with your finances? Let's begin with certified financial advisors. These professionals have the training and certifications to provide sound financial advice.
Certified financial advisors are trained to help you navigate your financial journey. Any certified advisor must be able to produce an FSP number, which stands for Financial Service Provider. You can search for any advisor's FSP number on the website fsca.co.za.
It is also worthwhile checking where and what exactly they have studied. Universities around the world offer numerous studies in the varied field of finances, so make sure that your chosen advisor has qualifications in the right field. In South Africa, one can also study at different financial institutes that offer professional designations such as FSA, RFP, or CFP. This kind of additional training shows that the advisor adheres to ethical practices.
When it comes to paying for the services, you'll find both fee-based and commission-based advisors in South Africa. Fee-based advisors charge their clients a fee, which can be a flat rate, an hourly rate, or a percentage of the assets they manage. This structure helps ensure that their advice is genuinely aimed at benefiting you. They have no interest in selling you a specific product or from a specific provider, as you are the one paying for their services. Thus, they are not incentivized to push specific products, ensuring their advice remains unbiased.
On the other hand, we have commission-based advisors who work with various insurance and financial product providers. They earn a percentage, their commission, from the financial products they sell, which can sometimes lead to a conflict of interest, and it will nibble away on the funds you invest. You don't pay anything up front, but you certainly will pay in the long run, and most likely much more than if you had paid a fee up front.
The commission-based fee structure is far more common in South Africa, but no matter which one you choose in the end, it is essential to ask any potential advisor how they get paid. Transparency gives you a choice. You want someone who is upfront about their fees and how they make their money. This way, you can be sure their advice is intended to benefit you and not just their pocket.
When interviewing a financial advisor, it is important to go beyond their credentials. You need to ensure they understand your full story. Start by explaining your financial goals, concerns, and any unique circumstances you might have. This helps the advisor tailor their advice to your specific needs.
Absolutely. You want an advisor who listens attentively and asks thoughtful questions. They should be genuinely interested in understanding your financial situation and not just eager to sell you any products. Look for someone who takes a holistic approach considering all aspects of your financial life, including budgeting, investing, retirement planning, and estate planning.
One of the pitfalls to avoid is choosing an advisor who doesn't take the time to explain things clearly. Financial matters can be complex, and you need someone who can break down complicated concepts into understandable terms. If an advisor is using too much jargon or seems impatient with your questions, they might not be the right fit for you.
Another red flag is if the advisor pressures you into making quick decisions. A trustworthy advisor will give you time to think things over and won't rush you into commitments. They should provide comprehensive explanations and allow you to make informed choices at your own pace.
It is also essential to verify their background. Check their credentials, ask for references, and look at any disciplinary actions or complaints. Reputable advisors should have a clean record and positive feedback from past clients, preferably someone who has been with this advisor for many years.
Transparency about investment strategies is another key factor. A good advisor should be clear about how they plan to invest your money and why. They should discuss the risks involved and ensure you understand them. Avoid advisors who promise guaranteed high returns with little to no risk. This is often a sign of a scam.
Finally, seek an advisor who is happy to educate you about financial concepts and strategies, empowering you to make informed decisions. Financial education is a cornerstone of long-term financial success, and a good advisor recognizes the importance of this.
In summary, choosing the right financial advisor involves careful consideration and thorough vetting. We highly recommend going to a fee-based advisor as this reduces the risks of a conflict of interest. But having said that, the fee structure of an advisor says nothing about the quality of service they will deliver. So it is really important to keep an eye out for all the other pointers too. Ensure they listen to your story, explain things clearly, and operate with transparency and integrity. That will help you build a trusting relationship that helps secure your financial future.
Trust in financial matters is paramount. By taking these steps, you can find a financial advisor who truly has your best interests at heart. Take your time and speak to a few advisors before choosing one. This will help you navigate your financial journey with confidence and peace of mind.
Let's move on to our next topic, evaluating financial institutions.
That is another key when it comes to entrusting your money to others. We all need them, but which one is the best to trust? Big banks and well-known investment firms often have solid reputations, but it's still vital to do your own research.
So let's talk about financial institutions. These institutions are the bedrock of our financial world, providing stability and security. When choosing a bank or investment firm, consider their fee structure, their track record, and their commitment to transparency. High fees can significantly impact your returns, so look for institutions with reasonable and clear fee structures.
I fully agree, but checking reviews and customer feedback is also important. A good reputation and positive customer experience are strong indicators of trustworthiness. It's like choosing a restaurant based on word of mouth. You want to know that others have had a good experience there.
Another important aspect is the range of services offered. Many institutions now provide sustainable investment options, which align your portfolio with your values by focusing on environmentally and socially responsible investments. This ensures your money is managed ethically and efficiently.
When we look at big banks in South Africa, several stand out for their service offerings and customer satisfaction. For instance, FNB is often praised for their innovative digital banking solutions and easy accessibility. Their banking app is user-friendly and offers a range of services from managing your accounts to making investments.
They also offer various savings accounts, including those that help you grow your emergency fund with competitive interest rates. I'm using them quite happily, and I believe you do too.
Yes, I do, for my business account. Privately, I actually use Capitec, the new kid on the block, which has grown rapidly due to its low-cost banking solutions and straightforward fee structure. Capitec is known for its simplicity and transparency, making it an excellent choice for those who want to avoid hidden fees.
Many banks also offer great fixed-term interest-bearing savings accounts, which can be a great option for keeping your emergency fund invested, but also accessible if you really need it. Here we do encourage you to look into all options, as many offers have minimum investment time and amounts. Depending on your risk tolerance, you can choose an option that is best suited to you.
I, for example, have a 5-year fixed-term account at Standard Bank for my emergency savings, and I get over 11%. Should I need that money before the due date, there is a fine to pay, yes, which depends on the number of days left until the due date. But it's not too bad. And the 11% make it quite attractive. So definitely worth thinking about it. For those interested in sustainable banking options, Nedbank is worth considering.
Nedbank has made significant strides in promoting green banking and sustainable investment products. They offer various funds that focus on environmental, social and governance, so-called ESG criteria. allowing you to invest in a way that aligns with your values. Their commitment to sustainability is evident in their efforts to support renewable energy products and reduce their carbon footprint. They also provide resources and advice on how customers can make more sustainable financial choices.
When it comes to accessibility and customer service, Standard Bank and ABSA are also notable mentions. Standard Bank has an extensive network of branches and ATMs, making it very convenient for customers to access their funds. Like all banks, they offer a range of financial products tailored to different needs, of course.
ABSA, on the other hand, has been improving its digital banking services and offers a variety of accounts that cater to different financial goals. Their focus on customer service and financial education is evidenced through their numerous initiatives aimed at helping customers make informed financial decisions.
It's also important to consider the range of accounts offered by these institutions. For instance, having multiple accounts, such as a current account for everyday transactions and a savings account for your emergency fund, can help you manage your finances more effectively. Look for banks that offer savings pockets or sub-accounts within your main account, allowing you to earn interest on your emergency fund while keeping it easily accessible.
Additionally, many banks now offer financial tools and resources to help you track your spending, set saving goals, and monitor your investments. These tools can be invaluable in managing your money effectively and staying on top of your financial goals.
In conclusion, when choosing a financial institution, consider their fee structures, customer reviews, range of services, and committing to sustainability. Look for banks that offer competitive interest rates on savings accounts and provide the tools and resources you need to manage your finances effectively.
By taking time to research and evaluate your options, you can find a financial institution that aligns with your values, meets your needs, and helps you achieve your financial goals. So make sure you choose an institution that you feel confident will manage your money responsibly and ethically.
Let's move on to the digital age. Online financial tools and platforms have revolutionized the way we manage money. They're convenient, often cost-effective, and offer a range of services from budgeting to investing.
Digital platforms like 22/7 and YNAB, You Need a Budget, are fantastic for budgeting. They link your bank accounts, helping you monitor your expenses and set saving goals. But let's dive deeper into why these platforms are so beneficial and how they work.
22/7, for example, is a South African-based app that not only tracks your spending, but also helps you understand your spending habits. It categorizes your expenses, allowing you to see exactly where your money is going each month. This transparency can be eye-opening and is essential for creating a realistic budget for yourself.
YNAB, on the other hand, operates on a slightly different principle. It's based on the philosophy of giving every dollar or rand a job. This means you allocate your income to specific expenses and saving goals, ensuring you're intentional with your money. YNAB also promotes a proactive approach to budgeting, which can be particularly useful for those who struggle with overspending.
For investing, platforms like EasyEquities or Satrix Now make it easy to invest in shares, ETFs, and other assets with low fees and no complex jargon. EasyEquities is particularly popular in South Africa because it allows you to buy fractional shares, making investment accessible even if you don't have a lot of money to start with.
Satrix Now focuses on ETFs, exchange-traded funds, which are a great way to diversify your investments. They offer a range of ETFs that track different sectors of the market, allowing you to spread your risk. This is ideal for beginner investors who may not have the knowledge or time to pick individual stocks.
These platforms are user-friendly and can be a great way to get started with investing, especially if you're new to it. They offer educational resources and tools to help you understand the basics of investing and make informed decisions.
And for those interested in automated investing, robo-advisors like Signia's robo-advisor and Outvest provide tailored investment solutions based on your risk profile and goals. Robo-advisors use algorithms to create and manage your investment portfolio, offering a hands-off approach to investing.
Signia's robo-advisor, for instance, uses a combination of low-cost ETFs to build a diversified portfolio for you. It automatically rebalances your portfolio to maintain your desired level of risk, which can be particularly beneficial for those who don't have the time or expertise to manage their investments actively.
Outvest offers a similar service but also provides access to human financial advisors if you need more personalized advice. They focus on goal-based investing, helping you save for specific financial goals like buying a house or retirement.
The convenience of these digital tools cannot be overstated. They allow you to manage your finances from anywhere at any time. Whether you're tracking your spending, setting up a savings plan, or investing for the future, these platforms offer a level of flexibility and accessibility that traditional financial services often lack.
Many of these digital platforms are designed with security in mind, using encryption and other safeguards to protect your data. This means you can manage your money with confidence, knowing your information is secure. And these platforms offer a wealth of resources and tools to help you achieve your financial goals in the most efficient way possible.
So Money Magnets, take advantage of these digital tools to streamline your financial management. With the right tools, you can gain better control over your finances and make more informed decisions about your money.
There is another point we should elaborate a bit more on, as this topic often confuses many: active versus passive funds. Alex, maybe you can explain the difference and why this matters.
Sure. Active funds are managed by professionals who make decisions about how to allocate assets and try to outperform the market. This involves a lot of research and frequent trading. Passive funds, on the other hand, aim to replicate the performance of a specific market index. They require considerably less management and typically have lower fees because there's less trading.
Active funds can sometimes beat the market, but it's rare and hardly ever consistent. The fees associated with active management also eat into your returns. That's why we strongly believe in exchange-traded funds.
ETFs are a type of passive fund that track an index such as the GSE Top 40 or the S&P 500. They offer diversification, lower fees, and simplicity. Historically, passive funds have often outperformed actively managed funds in the long run due to their lower costs and broad market exposure.
Investing in ETFs is a smart way to grow your wealth without the complexity and high fees of active management. It's sort of a practical choice for both new and seasoned investors.
Let's round off this episode by coming back to Heritage Day. As we celebrate our diverse culture, it is also a time to reflect on who we trust with our financial heritage. Heritage Day is a reminder of our shared history and the importance of building a secure future.
Heritage Day also encourages us to think about the legacy we want to leave behind. Trusting the right financial advisors and institutions helps us to build that legacy. It's about making informed decisions that will benefit not just us, but future generations as well, our kids and grandkids.
It's a good reason to reassess our financial strategies and ensure we're making the best choices for ourselves and our loved ones. Trust is earned through transparency, integrity, and consistent performance.
In the end, the person you should trust the most with your money is yourself. This is why financial education is so essential. Understanding your finances empowers you to make informed decisions and trust your judgment.
You speak from my heart, Anna. Financial education equips you with the knowledge and skills to navigate the complexities of money management. It helps you understand the risks and opportunities, enabling you to make confident decisions.
That's why we are so committed to providing financial education to as many people as possible, but especially to South African women. Financial empowerment is essential for shaping your own destiny and achieving your goals.
Keep focusing on your financial education, whether that be through free resources or paid courses like our step-by-step course, where we teach you everything you need to be successful at the stock market and build a secure and prosperous future for yourself and your family.
Thank you so much for joining us on this episode of our Money Magnet podcast. We hope this helps you to remember the importance of trust in your financial decisions and the power of financial education.
Trust in yourself and in the right financial partners is what helps you to build a secure financial future.
This is us for today, so remember, you are your best financial advisor. Happy Heritage Day, Money Magnets.
Stay tuned for more inspiring discussions and practical insights to help you unleash your full potential. And don't forget, you are a
Money Magnet!